This episode is brought to you by Marqeta, payment programs that scale and customer experiences that inspire. Don't sacrifice one for the other. Choose a payments provider who can deliver on both. Choose Marqeta. Learn more at marqeta.com/FTT. Hello, and welcome back to another edition of Not Fintech Investment Advice. As always, I am joined in today's episode by Simon Taylor, author of Fintech Brain Food. Simon and I spend some time talking about fintech companies that we're not really necessarily giving advice on whether you want to invest in these companies, but certainly you would want to invest your time in learning about these companies because they are very interesting. We cover a wide range of ground. Simon brings to me DeFi credit cards. I bring to him AI, accounts receivable. We talk about the largest asset class that's been brought on chain so far and what that tells us about the future of tokenized real world assets, along with a whole bunch of other fun ideas and some interesting potential opportunities to manifest in the fintech space. As always, I really enjoyed having Simon come on. I'm looking forward to seeing Simon quite a few times over the next couple of months as fintech fall travel season continues. But until that happens, you will all get to enjoy this conversation, Not Fintech Investment Advice, with Simon Taylor. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. All right, Simon Taylor is back and he is busier than ever. Mr. Taylor, you look like you're holding up okay. How are things?
I'm excited, man. We just confirmed the co-founder of Nubank doing their only fintech conference. Chris is going to be joining us talking about their US expansion. The new CEO of OpenDoor, Cagney, is going to be headlining for us, and we got a few more surprises to come, so I'm excited. Every day is a new day at Tempo, and my kids are healthy and happy. How are you and yours, my friend?
Everything is good. Everything is good. Kids are healthy and happy. 2 of the 3 are in school. The third one is she's taken that whole be ungovernable concept really to heart, and so utterly ungovernable in a way that will serve her interests long term, even though it makes my life a little challenging in the short term. I know you know exactly what I'm talking about, Simon, as a father of daughters, and it's all good. Very busy, kind of in the midst of fintech trade show season. As you said, I'm very much looking forward to NerdCon as the last conference of at least my fintech fall travel season. It's a great way to end the season, Simon.
That's kind of, somebody else pointed that out to me. It's kind of like the finisher. Like you're going to finish the conference season in Miami the week before Thanksgiving in something that's a lot more low key. That's around fintech operators and nerds. I think it's the thing you have to do. Tickets are available now.
I totally agree. All right, well, get your tickets if you haven't already. Very much looking forward to that. And Simon, as always, delighted to banter about some fintech companies. I know you have some good ones, so I'm going to cede the floor to you, and you are going to take us into your first fintech company, Simon Taylor.
Yeah, so meet EtherFi, and specifically their EtherFi Cash product. This is your DeFi native credit card. So you can use stablecoins or crypto for real world spending. So you deposit stablecoins from wherever you may have got them as collateral into this card, and then you can spend them directly. Or, better yet, you can park your stable coins and lock them up and borrow against them. So potentially you would be borrowing at something like a 4% rate instead of a standard credit card's 29% rate because you've collateralized the asset. But here's the crazy thing. If you look at the yields available on stablecoins, most of the market at the moment, it's somewhere between 8 and 10%. So this is possibly a point in time phenomenon, but it's also little bit hard to ignore that EtherFi's main project will pay you about 9% yield on your stablecoin holdings. You can then lock those stablecoin holdings as collateral, earning yield into this EtherFi cash account, and then borrow against those holdings at 4%. So you are net positive overall. You're borrowing at 4% and you are earning at 9%. So it kind of inverts the classic lending model. So this is entirely non-custodial, right? So consumer must hold their own keys in order to be able to do this. There's no, like, if you lose access, you've lost access to your money. So buyer beware. And you probably need to be in the crypto ecosystem to be able to use it. But it's pretty cool. I mean, essentially, as a consumer journey, you download the app, you connect an existing wallet like a MetaMask or something else to fund the account in some way. And then once you've got the app, you can add the card, the EtherFi Cash card, to Google Pay or Apple Pay. And, I've been buying things all week with it. It's genuinely incredible. So what say you, Alex Johnson?
Intrigued. I am intrigued, Simon Taylor. I'm glad you brought this one up. I'm glad you made this your first company because the lending side of the, let's call it stablecoin balance sheet, is an area that I have been thinking a lot about recently because, as you and I have talked about, and as we have been getting into various discussions with people on Twitter about, this is all happening with the backdrop of banks making an incredibly late, you could say too late push to try to get yield away from stable coins, which is something that I and others have argued is not going to be possible. And that to the degree that they had any chance of stopping that from happening, they should have pushed harder before the Genius Act was passed rather than after it was passed. But they've stirred up a whole debate around should stablecoins be allowed to offer yield. So I think this is really interesting because the broader context of the yield discussion is essentially where like deposits sit in our financial system and then what those deposits are used for, right? So Simon, if I may, can I ask you a couple of questions about this?
Please.
Okay. So first of all, it's a card. Is it a physical card? Can you get a physical card?
You can get a physical card, but it's also a virtual card. So it has an IBAN. It works anywhere. I think Visa is accepted. So it's a genuine card in that sense.
And it's, as a Visa card, it's issued by a bank partner, I'm assuming.
Yes. So under the hood, there will be a bank partner. Above that, there is likely somebody like Rain, who I think we've spoken about before, who are sort of doing a lot of stablecoin linked cards as an issuer processor almost for those stablecoin linked cards and program manager. So a little bit like you would see an I2C or Galileo or Marqeta type of.
Got it. And then EtherFi, they on the non-card side, do they issue a stable coin or a token of some kind?
Yeah, so they don't issue a stable coin, but they have created a token which kind of freely floats and is what they use for rewards as well. So they have a separate rewards capability too, and I think that funds a little bit of their cashback and whatever else. So create new token, let it float in the open market. And give that to your users as a reward currency. It's like Starbucks loyalty points, but that have some value and can be exchanged for cashback.
Got it. Okay, that makes sense. And then, so kind of tying back to the overall business model that you described, it sounds like on the sort of holding asset side, they can get you a return on your any of your assets, Ether, Bitcoin, stable coins. And then you have the ability to essentially on the lending side, borrow against those assets. And it sounds like, as you were describing, the return that you get on the deposit side is greater than what you pay on the lending side, which, Simon, just let's pause and analyze that for a second. That is like truly the inverse of net interest margin in banking. How does that work?
The risk profile is different.
Okay.
So the advantage of DeFi is it's completely separated into this modular thing. So there is no balance sheet here. There's nobody looking at both sides of the ledger. So balance sheets are the wrong metaphor to think about here.
Right.
There is
not one
market
institution trying to balance these things against each other. This is lots of different protocols all available to users who can navigate through them to find a return.
Yep. And so essentially, if you are looking to generate an 8, 9, 10% return, what you're doing is you're doing a sort of private credit investing. You are parking that somewhere, like a morpho or a centrifuge, that will be used by other borrowers. So you've become a lender. And so your deposit, your yield, is actually an investment. So your investment in private credit is a way to think about it. But really, also under the hood, it's technically a little bit different, because what you actually did is took some like almost cash you had in your physical wallet, put it in this magic lockbox that other people could use to borrow against whilst they did something else. But if it wasn't repaid, then, sort of there's some marketplace in the middle that's trying to figure out how all of that gets figured out and how losses get absorbed by the ecosystem. And then consistently, because it's leveling those things out as a software protocol, then you should end up with somewhere between an 8 and 10% return, depending on how the market performs. Again, a little bit like private credit. Now, in private credit, you would historically tranche that, right? So you'd have the bottom, you'd have first loss, and then you'd have tier, and then sort of prime or whatever it's called. I think it's a little bit different, and I don't understand the precise curves that an Aave, a centrifuge, and Morpho use. I need to get smarter on that. But yeah, that's kind of your primary difference here is don't think of this as a deposit that's funding lending. Right. Think of this as directly, you are the bank. You are like sort of funding lending, as it were.
Yeah, no, that makes sense. So this is all fascinating to me. And, the more you sort of talk through it, the more I can understand why banks are like, because it's very, very different from the way that traditional banking works. I mean, private credit, I think, is a good analogy. The interesting thing to me is, well, there's two parts, right? So one is just the sort of risk management component, right? And you sort of talked about different tranches and sort of like what happens if the entity that you're lending money to functionally doesn't pay you back, and like how is that managed? That's all kind of a black box to me. I will say that I guess I'm a little skeptical of sort of people making the argument, which you sometimes see in this space, that this is all just automatically handled by like the protocols involved. Like that always makes me a little nervous. Well. Yeah, please.
Remember, it's over collateralized.
Right.
So you're not fractionally reserving here. You're over collateralizing, and
right. So the theory is that if there's So the theory is that like if the risk profile changes in a way that moves against you, that person is over collateralized, and you can essentially liquidate their collateral under certain circumstances to regain your money. That's the concept, right?
Correct. And if that would be wildly inefficient in most market structures, unless for traders, the timing window in which you were borrowing and paying back the loan was seconds. So when you compress the timeline, then suddenly that becomes incredibly affordable, because there aren't many loans that you can take out from private credit that are 3 seconds in term. And that changes the economics.
That makes sense. And the collateral being like these highly liquid assets that just can be sold whenever, like that
like
that part
USDC.
makes sense to me. Like USDC, right? Exactly. So that makes sense to me. The other that then touches on the other challenge, right? Which is that it seems like this is a good trade at the moment when there's a lot of demand for leverage for trading against or with these assets. How do you see that sort of playing out longer term? Because to be honest with you, like when we think about private credit broadly, that I think is the thing that I think about a lot is I know it works in certain environments or certain parts of the cycle. I don't know that I know if it works in other parts. And that's when I think about lending, that's one of the things that I think a lot about is lending needs to work to a degree countercyclically so that like credit availability is still there even when the market is down or we're in a recession or there's a credit crunch or whatever. Like you need to have some availability for entrepreneurs to borrow money or for consumers to borrow money. How do you see the like kind of changes in the macro environment affecting the demand that's driving this like 8 to 10% return right now?
Do you know what's fascinating is in the bear market of late 22, early 23, certainly the returns you were getting on USDC did go down. But another thing happened, which is the collateral really shifted into really safe assets. So you tended to find that the things not only backing the stable coins, but also people were swapping in and out of like tokenized treasuries quite majorly if they were running large institutional kind of treasuries in some way. And now some of these crypto native institutions are massive organizations in their own right. And so they have now seen at least, I think, one major cycle. I put it to you that maybe private credit's seen 7 or 8 since the 70s, not nearly as big as it is now. But it certainly seems like the more we capital constrain financial institutions post-financial crisis, the more demand there is for private credit. And actually, there's an interesting question here of, wait, is everything becoming private credit? I mean, JP Morgan does private credit now. Are we just sort of saying that maturity transformation model might have run its course? Or,
banks do like retranche themselves into private credit, right? Like they'll stop doing the lending directly and then they'll lend to private credit funds because those assets are treated differently from a risk weighting perspective by regulators. So, I mean, it's a fair point that a lot of it is just becoming private credit.
Yeah, and so it's private credit all the way down, even from your balance sheet and what earns yield and what's the most capital efficient. And this is where, from the banker's perspective, I kind of reframe it. I think stablecoins and DeFi are a gift to financial institutions. Like, really, they are fundamentally creating just ample opportunity that will make the sponsor banking boom of 2020 look tiny in comparison to what's coming in front of us. I think a lot of folks thought the Durbin Amendment was a regulatory loophole, and maybe it was. But it was, as you know, designed to protect the smaller banks by letting them keep more interchange and the swipe fees. But what it actually did was bootstrap Chime and neobanks by creating a revenue model where these very small banks could potentially now share some of that interchange revenue. And of the 1.6 billion in revenue Chime made in 2024, how much of that was from interchange? 80%, 70%, something like that?
Yeah, like 75, 80%, yeah.
So how will stablecoin yield create new revenue models for non-banks, for the whole embedded finance space, for anybody who's doing payroll or payouts or pay-ins or corporate treasury management or cross-border remittances or anything of the sort? And who's going to clear all of that back to Fedwire? Who's going to be the one that's allowed to issue a card against that? Because I still think there is a little bit of regulatory moat that these financial institutions have. And we're in land grab time. And so can you be fleet-footed? Also, can you learn the lessons of Synapse and everything that happened with it to go through like thoughtfully? I think that's a giant opportunity.
When it comes to your payments provider, you can't afford to compromise. Marqeta's modern payment solutions flex with your business without the trade-offs. Stable and agile, secure and innovative, scalable and configurable. If they say you can't have it all, don't believe them. Your business demands more. Choose a payments provider that delivers more. Choose Marqeta. Visit marqeta.com/FTT to learn more.
Yeah, well, I will end by saying on the Synapse note that I think the other thing that's really important in this emerging space is just remembering that anytime you do credit or lending in any capacity, uh, consumer protection laws
Oh,
apply. And it doesn't really matter what type of lending you're doing, or if you call it a loan or if you call it something else. If you're lending someone money, consumer protection requirements apply. And I think that's going to be extremely important because, banks doing this, like they're obviously well practiced at consumer protection as it applies to lending. Fintech companies have had to become very practiced at consumer protection because they've been directly partnering with banks. But I think this is a very new frontier because obviously, like, there's a bank somewhere at the bottom of this issuing the card. But apart from issuing the card, like, a lot of the actual lending is happening on chain. It's happening through these like automated protocols. So a lot of the lending is happening well outside the purview of banks, but that doesn't mean it's happening outside the purview of consumer protection regulation, which is something I would caution anyone in this space to just keep in mind. Is like, if you're lending money, you are subject to UDAP, you are subject to TILA, you are subject to ECOA. Like, these things apply whether you think they do or not.
What's the old saying? Regulation is written in blood. My fear with all of these things, with sports betting, with prediction markets, with the rise of on-chain finance, is I believe all of them on net are going to be massive net positives, but there will be horror stories along the way. And why I'm sincerely urging people to at least be thoughtful about those risks as you go into them, and recognize that your bank partner might be the one who a future administration comes after and says, like, you were the reason all of this happened. So, like, there's a lot that could go wrong here.
Yeah, no, it's a good note of caution. Simon, can I give you my first one?
Please do.
All right. Well, in keeping with our sort of recent bend towards all things stablecoins and AI, I'm going to give you an AI one.
Go for it.
Okay. This company is called Lunos AI, Lunos AI, and they are building AI agents to automate the accounts receivable workflows. So essentially, the pitch is AI partner that works like a human AR clerk, but 24/7, never forgets, able to parse context, emails, customer history, etc. So they'll connect to your finance systems, email, invoice, and customer histories to get context on each of your accounts that you're trying to collect on. And then rather than sending like your generic reminders, which we have lots of systems that do that today, it will tailor its outreach, timing, tone, escalation based on customer behavior, based on negotiating dynamics, based on context. It can respond to questions, negotiate terms, escalate when needed, and then adapt its approach over time as it sort of learns what works best. It's interesting because the initial pitch is, hey, we will take work off of the people who are doing this, the humans that are doing this. We will scale the humans that are doing this. We will make your sort of generic automated systems that you already outsource some of this work to more effective and get a better result. But the longer term vision, which I'm kind of intrigued by, is to build like a network of these AI agents that kind of sort of integrate with each other, right? So I don't know, Simon, if you remember, this was like maybe 3 to 5 years ago, there was a big trend towards BNPL for B2B, right? And the concept was basically like, we'll create the like interlinkages between sellers and buyers in a B2B context, and then be able to create like the space and the context for financing within that sort of e-commerce like interaction. To me, this is kind of like the next evolution of that, where instead of it being like an e-commerce setting where we can then sort of like lend money against that or stretch out cash flows in that environment, now that interlinkage between buyers and sellers is going to be negotiated through AI agents. And you'll have AR AI agents, and I suppose you'll have AP AI agents, and they'll basically be like kind of negotiating with each other. And I'm really intrigued by the idea that we're going to build AR and AP webs of agents, and then like I suppose there will be companies that sort of govern the network or the connection between them. And these guys talk about building out, reconciliation, payment orchestration, sort of cash flow management. Like, there's a set of other jobs to be done, once you, I think, drive adoption of AI agents as the first touch point on both the AR side, which is where these guys are starting, and then I would imagine eventually on the AP side as well. What do you think about this guy idea?
I mean, it's the office of the CFO has been the gift that keeps on giving for fintech.
Yeah.
And I imagine AI will be no different. But what it makes me wonder is, do the Brexes and Ramps have a right to win in this space? And if not, why not? Because the interesting thing about those companies, especially Brex at the moment, I mean, holy crap, are they on a redemption arc? Both Brex and a company called Arc have launched spin-out startups focused specifically on AI native CFO. Like, wow. That would have been unthinkable a few years ago, that a company that's sort of building things launches a spin-out version of itself to be just AI native and focus on exactly this. But the AI transformation is not something where you start at the UI and you kind of work back. You start AI native. And I really do think it's a completely different interaction pattern, that we're moving from UI to AI. And until you get that shift, it's very, very difficult to just simply upgrade. But I wonder if this battle is a bit like Google's not nowhere in the AI conversation. Gemini is now the second most used consumer LLM. It's the default on Google search. You'll get the AI answer right there. Like, the Nano Banana is bananas. It's incredible. They are shipping some stuff. I wonder if the CFO stack kind of goes this way, where you've got these Luno-like sort of startups that are AI native, and then you've got the incumbents that can kind of get that way a little bit, and then you've got these little spin-outy ones. But I mean, look, why do I say all of that? I'm analyzing who wins and who loses instead of going after the value proposition, because the value proposition is like a no-brainer. Like, why wouldn't you want this? All of my life is in emails and spreadsheets, and something that can think in those emails and spreadsheets just makes a ton of sense. And pull one out for the procurement folks and the kind of the sales guys, because it's no fun, all that whole finance ops stuff. And all of the SaaS in the world makes it better, but it never made the spreadsheet go away. So the spreadsheet's probably going to stick around. Email's probably going to stick around. Wouldn't it be great to have something that could just do that and could learn how to do it?
Yeah, no, I agree. I mean, I think, like a very simple way of thinking about it is that, AR is the collections of the B2B world, right? The B2B payments world. I mean, it's like, and we've already seen significant adoption of generative AI and LLMs in the collection space. And the same concept applies here, right? Like, it's just obvious that you would want to have a more sort of nuanced, can parse unstructured data, can take some level of action without having to be directly overseen for collecting on invoices and nudging invoices along and keeping track of invoices. So, like, I think you're right. The value proposition makes a ton of sense. On the sort of winners and losers side, I would imagine what you described is exactly why these guys focused on the AR side as opposed to the AP side. Because I think the AP side is where more of this is already pretty built out, because you have the Brexes of the world, you have the Ramps of the world, you have the Arcs of the world. Like, anything that touches spend is pretty well AI optimized already. And I saw Ramp just bought a little company to sort of further accelerate its employees' use of AI. Like, those companies are all taking AI extremely seriously, and it doesn't seem like there's going to be a lot of room to, like, yeah, it's a little piece of Ramp, but more AI. Like, that just doesn't seem like a likely thing. I think Ramp is not a big and slow enough incumbent yet to sort of like cut out of those opportunities yet. And the same for Brex. On the AR side, though, I wonder if that's where there is a little bit more room, where the systems that have been built on the AR side are, they're definitely like digital. There's definitely been a ton of work that's been done in that space recently, but I don't know that there's quite the like super fast accelerating Ramp type execution machine just sucking up all the opportunities on the AR side. And so I do see maybe a little more opportunity there. But again, to the point we were making earlier, eventually these things are going to need to interface with each other, right? Like the AR side and the AP side are going to need to come together and kind of negotiate with each other. And, is there, I mean, like, here's another question. What's the MCP or the protocol that's used to allow AR and AP AI agents to communicate with each other?
That's
like,
a
who's built
fascinating question. That right there is $1 billion startup. Yes.
There you go. Let's use that. We'll cheat right now, Simon, and make that our manifest. Someone go build that. Someone build MCP for AR and AP agents.
Well, I don't know if it needs MCP for that, but I get where you're going. It needs a protocol. Because I can't move for another protocol launch lately. Google announces A2P, and then Stripe and OpenAI
too many to keep track of. Yeah.
Yeah, and then there was another one coming up, which is going to be my next company. They're all like, was it Cloudflare did X402? There's all of these, but they're all like taking a piece of the problem. X402 is my agent wants to get to the behind the paywall and pay for the use of intellectual property behind that paywall. And then you've got Google's agent to payment, which is like, I want to buy a thing in the future if the price comes down, but I want to tell the payments processor that was my intent a month ago, when the payment gets executed. And then Stripes is, I want to make a payment, and also as a merchant, I want to be able to display all of the stuff about my products inside of any agent, and it's like a handshake protocol between the two. Very consumer, very commerce focused. What's the AP AR version of that? Yeah, great question. I don't know if anybody's thinking about it, and if they are, they should open source it and land grab the thing, because there's a massive media win there.
Yeah, no, I totally agree. All right, Simon, give me your second company.
Well, conveniently, this is Circuit and Chisel. So Circuit and Chisel, weirdest name.
Yeah,
but they describe themselves as teaching AI how to pay and get paid. The goal is to make any agentic workflow accessible to any other agent and have it pay for tool usage without having to make a subscription. So right now, most of the things you use in AI are $20 per month after the free trial. How does an agent go, I'd really like to use your weather analysis tool because I'm planning a trip at the moment. Can I use it, please? And I'm only going to use it this once. I don't necessarily want to subscribe to using you all the time. You just happen to be the best for this job right now. And so that's what AXTP, which is the protocol that Circuit and Chisel have built, really allows people to be able to do. And so they've got some really interesting developer docs as Circuit and Chisel on how this mechanism could actually be baked into and around the model context protocol, which has already demonstrated strong adoption. So it's almost like a proposal to update MCP to allow agents to pay each other. So what does Circuit and Chisel actually do? Well, they're still very, very early. They really want to be able to help them deal with paywalls and limitations on payment friction, but they haven't necessarily said how. So I think it's kind of interesting, though. This team is ex-Stripe. They spent a little bit of time at Chainlink. This is people who've been both on-chain. It's people who've been in AI. It's people who've been in payments. And I think this kind of fits slightly into the different category, which is it's not saying everything has to be on-chain. It's not saying, like in a crypto sense, like X402 was sort of saying, although they seem to have pulled back from that a little bit. And it's not saying that it's about consumer commerce. This is agents paying agents. They need to figure out how are they going to actually pay each other without necessarily using a subscription. I think that as a payment flow is something that everybody knows is going to exist. Nobody knows when, but it's the most fascinating one.
Yeah, that's really interesting. I mean, so building on the general premise, and again, like we'll stipulate, I'm looking at their website right now. First, fascinating name, maybe most interesting name we've covered in Not Fintech Investment Advice. I mean, like,
Yeah.
normally you sort of you go for like the short name, the one word, ramp type name. Circuit and Chisel, that's different. I like it. So we'll stipulate that they're very early. We'll stipulate that they're like still in the process of kind of mapping out what this is going to look like. But the problem that you described is interesting, right? Because it's basically, once these AI agents are as capable as we think they're going to get, they are just going to scour the internet looking for the best way to solve the problem that they've been given. And in doing so, they are going to look for tools, services, other things that they want to use. And there's just going to be too many of those individual things. Like, I'm thinking, Simon, about like, you know how OpenAI and other AI labs will develop these like big partnerships with like different publishers for like training data or whatever, right? Like, it kind of, in some senses, it kind of reminds me, interestingly, of open banking, where it's like, oh, okay, Plaid and Chase are going to negotiate a deal directly, because there's a lot of like back and forth between those two entities, and they are going to like settle that themselves, like at a large scale. But this is like the long tail version of it, right? Which is that like Plaid's not going to negotiate a data access agreement with every small bank that's out there, because that just wouldn't make any sense. It would just not, it wouldn't scale, right? It doesn't scale to the long tail. And so they need a different way of doing that. They need APIs, they need partnerships with all of the companies that reach down into the little tail, like all of that kind of stuff. This, in some senses, kind of rhymes with that, where it's like, okay, the AI labs or via Cloudflare or others, like there's going to be these mechanisms that negotiate between agents or AI labs and large publishers, large services. Like, some of that's going to get worked out in sort of a bespoke manner. But the question is, for all of the long tail of these little tools, these little resources, these little ways where people have a thing where they want to get paid when it gets used, but they're way too small or way too niche to negotiate, or, to your point, to have an ongoing subscription with. Well, what does an agent do in that scenario? Do they like contact? Do they send the human being an email and wait for the human on the other side of that?
Well, so the way you'd solve that historically is you'd get an API key, and you would then have access to be able to use that tool if it was some like resource behind the internet, and that's like, that's setting up something entirely different. And so what in their developer docs, they say, well, why don't you just turn this tiny little long tail tool you have into pay per call pricing without having to set up any fancy billing or account management infrastructure? This thing can just sit there and say, I want to get paid, and get paid. Coming back to your APAR example, like, if they were going to find each other and use third-party services, like, sure, a lot of the time you could just go to OpenAI for it, or Anthropic, or there'll be somebody else that's done it, and they've done that. But it really, I think the power of MCP was, it became this like moment where people went, aha, this is a way to call any tool from any provider. It's not like locked into any one particular model provider. And the API model of doing payments and paying for things and subscriptions worked for the SaaS era, but I don't know that it's going to be the right answer for agent to agent. So there's a new business model here of like how does software pay for other software without humans in the loop all the time?
Well, and to that point, I think the other thing that's important to think about kind of on a broad basis is the tools that these agents want to use are mostly going to get built by other agents that are created for companies or people, right? Like, I think a lot about like, what does entrepreneurship look like 10 years from now or 20 years from now? To a degree, it's going to be like a kid who's 15 who has 25 different AI agents, where he's sort of given them direction on building little services or tools and making them discoverable. And like, those tools are all things that other agents are going to want to use. So like, it is an interesting way to think about, like, in the future, there's going to be agents that are offering tools and agents that are wanting to buy or use tools, and they'll need some way of interacting with each other. So the idea is very interesting. I will be honest with you. I have no idea how you sort of translate that abstract, sort of interesting philosophical conversation into an actual business. So I'll be very curious to continue watching. I know it's early, but to me, where the rubber hits the road here, I couldn't even begin to guess, to be honest with you.
So I have some proximity to like what is going on in Silicon Valley payments and AI lab circles, and I can say that this is like top of mind for a lot of that industry right now. Of like, this feeling that something's coming, and it's going to be possibly the most enormous payments opportunity in our lifetimes, and nobody knows quite what the answer is. So they're just trying to try things and put things out there, and it's an exciting time.
Yeah, no, it is. Well, and to your earlier point about all of these protocols, like. I feel like we're even right at the very beginning of like everyone is trying to launch these. Everyone is trying to launch them in a way that makes them feel very like open. Hey, come collaborate with us. And it's kind of the mode we're in right now, where it's like, I'm trying to think of the right way to say this. If everything is open source, but no one wants to participate in someone else's open source project, but to launch their own open source projects, it's sort of open source by name, but not in spirit, right? Like to a degree, some people are going to have to be followers and some people are going to have to be leaders for like this open source movement towards all these protocols to actually work. And I don't know that people who are all ambitious and who want to grab a big slice of whatever this new opportunity is going to be in the future, I don't think they've quite reconciled like, oh yeah, you're going to lead on this and we're going to participate versus no, we would actually prefer to lead on this. Like, I think we're still in the early days of sorting that out.
Which is why I thought the agentic commerce protocol with OpenAI was really interesting. Because that had sort of the OpenAI bit, which is how does any merchant build a shopping cart inside of any AI agent, including ChatGPT. And that's like a whole set of problems and really elegant solution for how I could, as a merchant, not change anything and potentially get a higher converting customer. That's the first time somebody built something where I was like, as a merchant, I might want to use this versus some of the other things out there that basically tell me I'm a commodity and I might get paid if I'm the best commodity. This is, okay, I can try and show up in some interesting and relevant way if it contextually makes sense. The second thing is the launch partner for the shared payment token, which is a way to make payments that can come from not just cards, but any wallet, any payment method, and can be used by any payments processor. That shared payment token is a fascinating concept, but Etsy is not a Stripe process customer. So here you have a launch partner from OpenAI using a new protocol, and the processor that's helped build it is not actually doing the processing for that merchant. So that was, I think, something that got missed a little bit in that announcement, but it's live for all 200 million US customers, I think, or 100 million or whatever it is, and those daily active users. ChatGPT is, to my mind, the consumer LLM. Like, there's no doubt they've
not even
cornered
close.
that
Yeah.
So if you are going to start seeing commerce actually happen, it's going to be in there. Will you start to see merchants adopt this and lean into it? Don't know. But there's a distribution channel here that looks like web and mobile and the next big thing. And you could bring your existing processor and you can bring your existing back office. That, to me, feels like a tangible business case I can make versus, hey, everybody, look how open we are. We're so open. We use our open thing. Look at all of the logos that we've got on our launch slide. You know, that's easy to get because everybody wants to be seen to be doing something. Actually demonstrating it with volume is, I think, where the conversation's shifting.
No, I agree. And I think ultimately the choices that companies like OpenAI make are going to determine this because they're the ones who have the leverage with the users, right? Like they'll be able to direct traffic on a massive scale to the protocols or to the partners that they think are the best fit. So an interesting space to watch. Simon, can I give you one more before we sign off?
Please do.
All right. This is one I know you know, but I don't think we've talked about it on this show. Not exactly a small company, but one that strangely flew under the radar for years until they just went public, which is Figure. And I wanted to talk about them because they are like right in your wheelhouse. We haven't talked about it on the show. They did, as I mentioned, just go public. They their IPO was a success. They were priced at, I think, $25 a share. On the first day of trading, it opened at about 36, so there was a lot of demand for it. I think it's since sort of settled in somewhere between $30 and $38 a share. This is, of course, Mike Cagney's company that he founded after SoFi. The fact that it's now gone public at the valuation it went public puts Mr. Cagney in a pretty rare air of people who've taken multiple fintech companies public at these numbers. It's not a huge club, so clearly he knows how to do this. Simon, I know you know this, but just to kind of recap quickly for listeners who maybe haven't been paying as much attention to Figure until recently, it's basically a company that uses the blockchain to bring lending, capital markets, asset management all on chain, right? And so the basic place that they started was in home equity lending, where I think initially Figure provided the lending themselves and was doing lending based on their sort of provenance blockchain. They were making home equity loans, cash out refinances, other sort of mortgage related lending products. And then the critical piece was providing a marketplace, I think they call it Figure Connect, that allowed originators, other originators besides Figure, to originate home equity loans using their process and using their sort of approach to underwriting. And then investors to buy sort of the tokenized home equity assets on their sort of secondary market. So think of it as sort of the on-chain equivalent to like the Fannie, Freddie, GSE sort of ecosystem specifically for home equity. And then since then, and I don't think people really realize this, but like Figure has quietly been putting so many home equity loans on the blockchain that it is by far, as I understand it, like the most like tokenized real world asset of anything that exists. Like if you're looking for like actual
outside
like
of US Treasuries,
scale, right? Outside of US Treasuries, it's US Treasuries and then it's home equity loans. And now, obviously, Figure is trying to scale up beyond that. They've gotten into more things around stable coins, providing sort of different ways for investors to generate yield, building sort of on-chain native like lending products and kind of moving beyond home equity. But Simon, it feels like an inflection point on a number of levels because, as you said, we've been doing the U.S. Treasury tokenization thing with stable coins, and now we're starting to get into tokenized deposits. Vlad at Robinhood has really been pushing on tokenized real estate, tokenized stocks, all of these other things. So this push to move assets on chain is now really picked up steam, I would say, in the last 6 months. But here comes Figure that's been doing this kind of somewhat quietly and under the radar for a long time. What do you think of Figure, and like where do you think it goes?
Yeah, you could look at this two ways. If I was to make like the bear case, I would probably say, oh, this is peer-to-peer lending. We'll see this go away in the next market cycle. That all ended up as private credit and non-bank lenders, and some of them ended up getting a banking license. I think the difference here is one, that, a couple of fold. One that Mike Cagney has experience building credit businesses generally, and so the step one was to execute this better than the peer-to-peer lenders did. And if you just did that, you'd have a successful business that could probably have made it to IPO. But what makes on-chain so unbelievably interesting is your back office as a non-bank lender. So that private credit ecosystem is incredibly manual, incredibly paper-based, and incredibly expensive in some ways. And some of it is you have to draw down and wait for capital to come in the door before you can lend it in the first place. What going on chain does is it allows you to secure a line of credit and only draw down from that line of credit the moment a loan comes through the front door. So it's straight through. And that is cryptographically enforced per the terms of the contract and the agreement. So that sort of set of like hidden pain that somebody in finance ops used to have to deal with is just all automated away. And you could have automated that with software, but you have this interesting many-to-many problem of there are many potential on-chain lenders, there are many, financiers, there are many potential on-chain lenders, non-bank lenders, and so Figure is one of those, but there will be many others in the future. So if I'm sort of a private credit fund, I want lots of companies that look a bit like Figure and lots of marketplaces that I could deploy my capital into. And if I'm Figure, I want lots of people that are on chain that can supply credit into my ecosystem. Mike Cagney has bootstrapped some of that in a sense and made this another asset class that goes on chain. And so what you get is this inevitable compounding benefit. As more and more assets go on chain, there's more and more liquidity on chain, and they become more and more efficient and more remixable in a way that historically we were recording balances inside of a mainframe somewhere, and then we had to figure out the paperwork and reconcile them because those mainframes were built 20, 30, 40 years ago. This is all, well, I've got a golden source. I've got a perfect record, and I've got cryptographic signatures that allow other untrusted actors to have a shared workflow between themselves. So I could have centralized all of this. I could have said, you know what, I'm going to build a lending utility like a Fannie or a Freddie, and it's going to enforce all of these private credit arrangements between each other, and it's going to be some sort of clearinghouse for them. That's the way we would have done it historically. But then I go back to, well, this is instant, it's 24/7, and it's global. So unless there's any regulatory blocker, there's no reason why two people and a dog couldn't buy one of these loans from Nigeria or from, the Bahamas or wherever they may be. There will be some regulatory issues, I'm pretty sure, as all finance goes on chain, like caution.
Yeah.
But Mike Cagney has been a visionary for a long time, so it makes a ton of sense to me.
Yeah, I mean, I think you make a good point, right? I mean, there's a version of this that doesn't work because it just wanders into like a regulatory zone of pain and just gets kind of smashed. And that happens a lot with this. From what I've seen so far, like Mike Cagney knows how all that works. He knows what that world looks like. The fact that loans that are being originated and then sold on this sort of on-chain environment that Figure has created, the fact that those are getting rated by the rating agencies, just like any other securities that investors buy, that's a sign to me that this is buttoned up in a way from a regulatory perspective that's very different than what you see in kind of the Wild West sort of DeFi space, where they're sort of hoping that, rating agencies just don't ever even look at what they're doing. So I think the fact that they've steered into that and have made that we want to get these markers and these proof points done makes a lot of sense and has positioned them well. Maybe not as well for the super duper immediate term where there doesn't really seem to be any rules and we don't really care about anything. But again, Cagney's been around for a while. He knows how this works. We are going to slide into a new regulatory environment sooner than we maybe think. And it could be very vengeful against anyone who's not doing this in the way that regulators are going to be comfortable with. And I think that risk is much lower with Figures. So I'm always fascinated, Simon, with the companies we talk about on this show because it's a function of timing, right? Figure's been kind of quietly building this through sort of when crypto is up, when crypto is down. They've been kind of sort of quietly building that whole time. And they've been, in some senses, I think, going slower or more carefully because they have wanted to check some of those boxes around making rating agencies feel comfortable with these securities, getting investors to feel comfortable. Like the point you made earlier about the costs, one of the things that Mike has told me in the past is that their whole goal, the way they measure a lot of their success is, can we use the blockchain to just knock the costs of some of those back office things down, right? It used to cost X to review a home equity loan as a part of a portfolio of home equity loans that you were going to be buying as a security, because you had to manually go look at the loan tapes and do all of that stuff by hand, and it cost whatever $100 per loan to review. If they can knock that down to $10 or to $1 just because it's all on chain and the data's right there and it's originated in a consistent fashion, that cost savings actually matters and makes it more efficient and draws more liquidity in. And so I think, people often use the term flywheel, and I think it's often misused because it's like, oh, we've assembled a bunch of things and we figure if we can just push it and it gets enough momentum, things will happen. And sometimes that happens, but it's more like an accident. This is like an actually meticulously constructed, we're going to put this here, we're going to put this here, we're going to put this here. And everything we add is going to add momentum and add things going. So it's like, it is a flywheel in a more, I think, classic sense and something that takes a longer time to build, but I feel better about it sustaining its momentum. Does that make sense?
My life is a constant cycle of people discovering that weird thing I was into 5-6 years ago that I thought nobody would ever care about. And once it was fintech, and then it's now it's become sort of like the on-chain lending space and DeFi.
Sure.
Look, everybody cared about it when it was hot in 2020, 21, but
then it
wasn't mature enough yet.
Simon.
But there were people even back then that were quietly building, like Mike and others, and there will be many more that start to appear that have been quietly building for as long, if not longer. And it's kind of always the question of how long will it take for there to be enough liquidity on chain? And I can tell you that JP Morgan Connexus, whilst it's a closed loop, is moving at least $2 trillion annually. And there are now global corporates pushing their banks to go on chain. That when your customers are pushing you to go on chain, you inevitably follow your customers and their demands. So that will now start to happen. And, Genius was a really big unlock moment for people to start to do things. So, there's nothing to say. We might not end up in a fintech and AI and crypto bear market in 2 years' time, and everybody will have forgotten about all of this stuff. And the topic of conversation will be, how do we clean up the last regulatory mess? But during that time, there will still be people quietly building things, and inevitably tokenization gets bigger, not smaller.
Yeah, no, I think that's totally fair, and it's just I think Figure's a good reminder of everything you just described, which is these things just take a while. You can't. I think sometimes we get a little impatient in fintech, and especially in crypto circles, it's like everything needs to move at lightning speed. But I think Figure's a good example of one that it was just a slow burn because that's the way it was going to happen. And building it in a space like home equity first. I mean, anyone who's messed around with home equity knows it's really complicated. There's a lot of regulatory and process stuff that you have to work through. So starting with the hard, slow thing first often does benefit you down the road. Simon, I know we're over time, so I will let you go. I feel pretty good that we manifested right in the middle of our discussion more protocols. I know it's hard to keep track of all these acronyms, but it feels like that's the moment we're in.
It is. Maybe we just need one protocol to rule them all, and you can cue the Dilbert sketch right here.
There you go. Okay, well, that's a perfect note to end on. Simon, as always, a joy to see you. Thank you for carving out some time.
Thank you, sir.
Thank you for listening to this episode of FinTech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love FinTech Takes, please tell a friend.